A very warm welcome to all. My name is Neal and today I'll be presenting my seminar on discounting cash inflows, understanding the time value of money. In this section, I'll be explaining how discounting helps us evaluate the present worth of future cash receipts and why this concept is essential in modern financial decision making. Discounting cash inflows, understanding time value of money. Discounting cash inflows is the process of finding out the present value of future cash receipts by applying a discount rate. It reflects the time value of money, meaning that money received today is more valuable than the same amount received in the future because of its earning potential. This helps investors and business compare future inflows with current investments and make better financial decisions. The foundation why money today is worth more. The time value of money is one of the most fundamental ideas in finance. Money available today can be invested immediately to earn returns and grow through compounding. There are three core reasons why a rupee today is worth more than a rupee tomorrow. Opportunity cost, since today's money can be invested. Inflation, because future money will have less purchasing power. And risk, as future cash inflows may not occur as expected. Present value formula, the mathematical framework. To find the value of future cash flows today, we use the present value formula. Present value equals future value divided by 1 plus the discount rate raised to the number of time periods. For multiple cash inflows, we calculate the present value for each cash flow and then sum them up. This framework forms the base of discounted cash flow analysis, allowing us to measure what future money is worth today. Discount rates, choosing the right rate. Selecting the right discount rate is crucial. It should reflect the risk profile, market conditions, and opportunity cost. We start the risk-free rates like government bond, add a risk premium, and adjust for inflation. In general, low risk projects use 3 to 6%, moderate risk projects use 8 to 12%, and high risk ventures can go up to 25% or more. Single cash flow versus multiple cash flows. When analyzing cash inflows, we may deal with either a single payment or a series of payments. A single cash flow could be bond maturity or a property sale, while multiple inflows are common in rentals, dividends, or project revenues. For each cash flows, we find its present value, sum them, and subtract the initial investment to get the net present value. If NPV is positive, the investment creates value. Real world applications. Discounting cash inflows has real world applications in almost every area of finance. In capital budgeting, companies compare the NPV of expected cash inflows with the cost of investment to decide on projects. In real estate, investors discount future rent or sale proceeds to find fair value. And in mergers and acquisitions, buyers discount projected cash flows to decide the purchase price of a company. Thus, this method helps determine real value across the different business scenarios. Common pitfalls and how to avoid them. Even experienced analysts can make mistakes when discounting cash inflows. Common errors include using the same rate for all projects, mixing nominal and real cash flows, or forgetting to include the terminal value at the end of the project. Sometimes analysts assume all inflows come at year end, which may not be true. To avoid these, always match rates correctly, include residual value, and perform sensitivity analysis to see how different rates affects valuation. Practical example. Let's look at an example from the PDF. A company invests 5 lakh in new equipment, expecting cash inflows for 5 years. By discounting each inflows at 10%, the total present value becomes 6,60,160. Subtracting the investment gives an NPV of 1,60,160. Since the NPV is positive, the project is financially profitable and should be accepted. In conclusion, discounting a series of cash inflows helps us to determine the true worth of future earnings in today's money. It ensures that the time value of money is properly accounted for while assessing investment profitability. This concept forms the foundation of all major financial decisions, from corporate investments to personal financial planning. Thank you and have a nice day.